Hi, welcome back to the channel. In today's episode, I want to talk to you about what's happening in the Chinese economy because it's just released its latest figures, which show that the economy expanded by 4.3% in the second quarter of 2026. And that was down sharply from the growth of 5% during the first 3 months of the year. It was weaker than economists had expected, and it's the slowest quarterly growth rate that China has reported for more than 3 years. But potentially the most concerning part is that the 4.3% growth rate was also below the bottom of the Chinese government's official target range of between 4.5 and 5%. So despite all of the stimulus measures, all of the industrial support, all of the government spending and China's huge export machine, economic growth is now heading in completely the wrong direction. And when we dig beneath the headline figures, the situation looks even more concerning because China currently appears to have two completely different economies. On one side, it has factories pumping out electric vehicles, batteries, semiconductors, industrial robots, and a huge range of manufactured goods to export around the world. But on the other side, Chinese households are worried about jobs, worried about incomes, worried about falling property prices, and increasingly reluctant or simply unable to spend money. That is not a healthy or sustainable economic model. And in this video, I'm going to explain exactly what's gone wrong, why the latest figures are potentially a major warning sign, discuss whether China can still achieve its full year growth target of 5%, and why this slowdown could have serious implications for the global economy. But before we get into all of those details, could I ask you to give me a thumbs up for this video? Please subscribe to the channel if you haven't done so already. It's not really a subscription, you're not paying me anything. You're just pressing that red button to tell YouTube that you quite like my sort of videos. And if you have the option, if you could hit that hype button, you can see it might say hype next to the thumbs up. If you could hit that, it will really help this video to be promoted to more people and hopefully pick up some more views. So let's get started with the headline figures. China's economy grew by 4.3% in the second quarter of 2026. And that was compared with the same period from last year. Economists had been expecting the growth to come in at 4.5%. So this wasn't merely a slowdown, it was a clear miss against market expectations. And compared with the first quarter's growth of 5%, China has lost 0.7 of a percentage point in only 3 months. Now that might not sound particularly dramatic, but when we're talking about the world's second largest economy, that represents an enormous loss of momentum. On a quarter-to-quarter basis, the economy expanded by only 0.9%. For the first 6 months of the year, overall growth has come in at 4.7%. Now, technically, that first half figure of 4.7% is still inside the government's full year target range of between 4.5 and 5%. And I'm sure that will be the figure that the Chinese authorities want everybody to focus on. But the important issue here is the direction of travel, the trend. China started the year growing at 5%. It has now slowed to 4.3%. So unless the economy stabilises or accelerates during the second half, China will find itself missing even the bottom end of its target range. To achieve full year growth of 4.5%, which is much lower than the 5% that China has been hitting every year, China would need the economy to grow by roughly 4.3% in the second half. However, to achieve growth of 5%, which is really the key target, it will need a dramatic rebound in the second half of 5.3% growth. And based on what's happening with property, investment, household spending and the labour market, that 5% figure now looks extremely challenging. The latest Reuters polls expect growth of around 4.6% for the full year, before slowing further to 4.4% in 2027. The International Monetary Fund, the IMF, is also forecasting growth of 4.6% for this year and is citing higher global oil prices, prolonged uncertainty and structural economic problems as the challenges facing China. So China may still scrape into its official target range of 4.5 to 5, but even that would represent another slowdown from the 5% growth recorded in 2025. And remember, China is no longer a rapidly developing small economy. It has a huge population. It's around 1.4 billion, although I'm sure some of you will send me messages saying it isn't anywhere like that. Enormous debts, a shrinking workforce, a prolonged property crisis, and an economic model that is still heavily dependent on investment from the government. So maintaining growth becomes increasingly difficult every year. The most worrying figure in the latest data was not actually GDP, it was investment. Fixed asset investment fell by 5.7% in the first 6 months of this year. That includes spending on factories, buildings, infrastructure, machinery, and other long-term assets. And even investment by state-controlled organisations fell by 2.3%. This is extremely significant because investment has traditionally been one of the main engines of the Chinese economy. Whenever growth slowed in the past, local governments borrowed money, launched infrastructure projects, encouraged property development, and ordered state-owned companies to invest. But that engine is now starting to splutter. Local governments are heavily indebted, revenues from land sales have collapsed, and many authorities are cutting costs rather than launching new projects. China's local government financing vehicles were estimated to have accumulated liabilities of around 71 trillion yuan by the end of 2025. That's around about 10 trillion US dollars. So that's equivalent to more than half of China's annual GDP. Beijing has introduced a huge debt swap program to refinance some of these obligations, but refinancing old debt doesn't necessarily create new growth. It simply moves the problem around the financial system and delays the day of reckoning. It basically just pushes out the repayment date. And then we have the property market itself. Property investment fell by 18% in the first half of this year. That is an extraordinary decline. New construction starts, property sales, and investment all continue to fall, while average new home prices dropped further in June. Prices fell by 0.1% compared with May, and although that was slightly better than the previous month, the broader property market remains under severe pressure. This matters because property has historically represented a huge proportion of Chinese household wealth. For many Chinese families, an apartment is not simply somewhere to live, it's their pension, their savings account, and their primary investment. So when property values are rising, people feel wealthier and are more willing to spend. But when prices are falling, as they have been in China for many years, unfinished developments remain scattered around the country and developers are defaulting, households become much more cautious. They stop buying new cars, they delay replacing their phones, they cancel subscriptions, they avoid restaurants, holidays, and non-essential purchases. And that's exactly what the latest consumption figures are showing. Retail sales increased by only 1% in June. By comparison, industrial production expanded by 5.3%. So factories are increasing production more than 5 times as quickly as Chinese consumers are increasing their spending. That gap is the central problem facing China. The country is producing far more than its own households are willing or able to consume, and the only way to bridge that gap is to sell the surplus overseas. Exports surged 27%, supported by strong international demand for semiconductors, electric vehicles, and other technology-related products. Some of that demand was also reportedly being brought forward by American retailers trying to secure goods before possible new tariffs later this year. On the face of it, a 27% rise in exports looks fantastic, but it also makes China increasingly dependent on foreign consumers at exactly the same time that governments around the world are becoming much more hostile towards Chinese imports. The United States is considering further tariffs on Chinese imports, the European Union is looking at stronger measures to protect its industrial sectors, and countries around the world are becoming increasingly concerned that heavily supported Chinese manufacturers are flooding their markets with cheap products and making it impossible for local businesses to compete. China is effectively attempting to export its way out of a domestic demand crisis. But the larger its trade surplus becomes, the greater the political backlash is likely to be. And if exports begin to slow, there is currently no obvious demand engine waiting to replace them. One economist quoted by Reuters summed this up rather neatly. China may not change its economic strategy until exports fail. At that point, Beijing would be forced more to stimulate household spending, but waiting for the export engine to fail before repairing the domestic economy is an extremely risky strategy. The other major problem is household income. Wages have reportedly stagnated or fallen in some parts of the economy. Factories are cutting jobs because of excess capacity, tariffs are brutal, and price competition is also fierce. Artificial intelligence is reducing the growth of some white-collar roles. The property crisis has destroyed jobs in construction and related industries, and tens of millions of workers have moved into delivery driving, ride-hailing and other gig economy jobs with lower pay and weaker social protections. When people don't feel secure about their job, their income, their pension or their healthcare, they don't rush out and spend money. They save it. And this is why simply cutting interest rates or telling banks to lend more money may not solve the problem in China. China doesn't necessarily have a shortage of credit, it has a shortage of confidence. In fact, household loan defaults have now risen to record levels. Non-performing household debt reportedly reached 2.2 trillion yuan in 2025, equivalent to around 325 billion US dollars or 1.6% of China's economy. The problem is believed to affect roughly 1 in 10 Chinese adults. So encouraging people to borrow even more money when their incomes are already under pressure may simply create another financial problem. And this leaves Beijing with a difficult choice. The government could launch another huge stimulus package. It could give more money directly to households, increase welfare support, provide larger consumer subsidies, rescue local governments and intervene more aggressively in the property market. China's already set a budget deficit of around 4% of GDP for 2026 and plans substantial bond issuance to support the economy. But aggressive stimulus would increase the country's already enormous debt burden. And if the money is once again directed towards factories, infrastructure and industrial production rather than household incomes, it could make China's imbalance even worse. China does not need another 100 factories producing goods that Chinese consumers can't afford to buy. It needs households that feel financially secure enough to spend. That means improving wages, pensions, healthcare, unemployment support and social security. But those reforms are expensive, politically complicated and would require China to redirect the resources away from local governments, state-owned enterprises and its industrial strategy. This may explain why policymakers repeatedly acknowledge that domestic demand needs to improve but appear unable to agree on exactly how to achieve it. The People's Bank of China says the monetary conditions are already relatively loose. Further interest rate cuts might support borrowing and property prices, but they could also put pressure on the Chinese currency and encourage capital to leave the country. Meanwhile, higher energy prices caused by the war in Iran are increasing costs for Chinese factories and potentially squeezing profit margins. China has large energy stockpiles, a diverse supply base and state-controlled fuel prices, so it has absorbed much of the initial oil shock. But if elevated energy prices persist, they will become another drag on an economy that's already losing momentum. And all of this matters far beyond China. China is one of the world's largest importers of oil, iron ore, copper and other commodities. If construction, infrastructure and manufacturing investment weaken, global demand for those materials may fall. Mining companies, commodity exporting countries and businesses throughout the global supply chain could all be affected. At the same time, China may respond to weaker domestic demand by exporting even more products at lower prices. That could create cheaper goods for consumers around the world, but it could also intensify trade tensions, destroy manufacturing jobs elsewhere, and trigger another wave of tariffs and protectionism. So China's slowdown presents the global economy with two different risks. China could import less from the rest of the world, and it could attempt to export more to the rest of the world as well. Neither of those developments would be particularly comfortable for its trading partners. The official Chinese description of the first half was that the economy remained within an appropriate range and demonstrated strong resilience. And to be fair, there are areas of genuine strength. High-tech manufacturing increased by more than 13%. Production of lithium-ion batteries rose by around 40%. Industrial robot production increased by 28%. China remains an industrial and technological powerhouse. But that's precisely the problem. China's factories are booming while China's households are struggling. Production is strong while consumption is weak. Exports are surging while domestic investment is collapsing. And the property market, which supported household wealth, employment and local government finances for decades, remains trapped in a prolonged downturn. So the headline figure of 4.3% is not simply a disappointing quarterly result. It's another warning that China's traditional economic model is running out of road. Beijing may still achieve growth of between 4.5 or 4.6% this year, but achieving a target on paper is not the same thing as fixing the underlying economy. And unless China can persuade its households to spend, repair the property sector, stabilise local government finances, and become less dependent on exporting manufactured goods, each year's growth target is likely to become more difficult to achieve. Things are not going according to plan. China's economy is slowing, the imbalance between production and consumption is becoming more extreme, and Beijing is running out of easy solutions. And if exports eventually weaken as tariffs rise and the global economy slows, the real test of China's economic model may only just be beginning. So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking. If you have liked what I've said, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. Please hit that hype button as well if you can see it and you haven't done it before, just give it a little press. It will definitely help this video to be promoted more, so really appreciate that. Thank you so much to everyone that's supporting me. If you bought me a coffee or sent me YouTube super thanks or signed up as a patron or a member, thank you for that support. It genuinely keeps me going. Without it, I don't think I would have carried on this long. It does give me the motivation each morning to basically make some videos to keep everybody in the loop and everybody happy, and to show my appreciation for that support. So thank you so much if you're one of the people that is supporting me, and here's something to put a smile on your face.